It's been a slippery slope for crude oil prices. They have extended their decline for the third straight session now. In fact, slipping below $100 to the barrel mark briefly and trading at a session low of $98.50 to the barrel. But since then, it has gained some amount of ground. Now Brent futures are trading at around $101 per barrel. The fears of a potential global recession is spurring concerns about the demand for oil. There are also supply-side disruptions expected, and this with the Caspian Pipeline Consortium, the CPC, being asked to suspend activities for 30 days by a Russian court. Besides this, in another significant piece of news, the British Prime Minister Boris Johnson has decided to step down as the leader of the Conservative Party in the UK. Boris Johnson has decided he's going to carry on as Prime Minister, at least until a new leader is appointed. Until yesterday, the British Prime Minister had been rather adamant on his stand that he is not going to give in, despite dozens of resignations from his own government, from his ministers and officials. The events, of course, have set into motion. This happened when the Chancellor, Rishi Sunak, resigned, and he cited lack of trust in the leadership of Boris Johnson. After Rishi Sunak's resignation, there were dozens of ministers and officials who started resigning from the government. And of course, we've seen Boris Johnson finding himself between a rock and a very hard place. And eventually, he's decided to step down as the leader of the Conservative Party. But of course, he continues as the Prime Minister until a new Tory leader is found. Let's put these major developments that we are seeing, whether it's from the markets and what we are seeing in Britain. Let's put this in context. Manish Singh, Chief Investment Officer at Crossbridge Capital, is joining us. Great to have you with us, Manish. Now, you know, if you look at the last two quarters, they've been rather tough. If you look at what the Indian government has been going through especially, the economy has been hit by a heavily declining rupee against the US dollar. Prices have been rising across commodities. Consumption levels have been extremely erratic too. So when the RBI increased rates with its imminent hawkishness to control inflation, all of us started wondering if the measures have been too strong and whether this would invite stagflation in the near future. In your assessment, with the kind of prices we are seeing crude oil at, and perhaps the trajectory as it's likely to play out in times to come, with demand going down, despite there being supply-side concerns as well, how is India and its economy poised, according to you?
So let's look at the Vikram. Let's look at the oil prices first. You will see various speculations about where the oil price could be. You saw JP Morgan, I believe, said it could go to $380 per barrel, which is astounding. But of course, that was in a very special scenario. And then you had some other houses saying that crude oil prices could go to $65. It's the second one that I buy. As I have said before on the program as well, I don't think there's any lack of oil in this world. So it's more a matter of how do you deliver and where do you deliver. And of course, things are being upended by not just supply chain, but also what's happening with respect to the Russia threat. But even if you look at Russia, they are really pumping out more oil than ever before. Of course, selling it to India and China, not to Europe, as was the case. So if you look at the availability and where things are, I think there's plenty of it. And I would think that oil prices are going to be lower by the end of the year and not higher. So if you keep that in mind, then that should help from inflation point of view as far as US is concerned. But even if we talk about inflation, I mean, inflation is probably a much bigger and serious problem in the US on the headline ways. The core inflation in US is also coming down. In Europe, inflation is entirely an energy thing. It's not driven by core. Inflation in China is very less and few. Inflation in India, even though we talk about, but it's not at an alarming rate as we have seen in the past. So according to me, I don't think inflation is a sustainable problem. And anything that is driven by energy, of course, it can cause problem in the short term, and it is. But if you take a 3-month, 6-month view, I do not see that these prices can sustain, and the prices are heading lower. And you're seeing that from signs of the fall in consumption and the forward-looking growth. The Q2 growth for US is now, at least from the Atlanta Fed model, is at minus 2.1%. So we are already in a technical recession. Right. So if that keeps hitting consumption, then that is not going to help with the oil prices.
But Manish, since India is a net importer of commodities and prices of commodities have been cooling off, perhaps because of the fears of slowdowns and recessions, we've seen, like we mentioned, the very important crude oil go below $100 a barrel. Metals, edible oil prices, they seem to be cooling off. Only yesterday, here on the show, we were discussing the lower prices of palm oil that India imports from Malaysia and Indonesia. I want to ask you if there is a growing opportunity for India to tap into, since we are a net importer and we do have a yawning current account deficit to show for it, but our forex reserves are not bad. If you do believe it is an opportunity, do you think the government here sees it as well and is using it to its advantage?
Well, I think they are, because if you speak to, and I have had several conversations on this front, what's happening in the energy market, you are seeing India benefit from that, I should say, even though given where the prices are. And you are seeing the Indian oil companies refining oil at a record rate. I think some of them probably are making its way back into Europe as well, as it always happens when you have sanctions and other things. So that's a good thing. The second point, I would say that even if second point, I should say Fed. Let's talk about Fed for a minute. I strongly believe that Fed, of course, is going to increase rates on July the 27th because they have tied themselves very closely to they want to raise rates next time. But the forward-looking data just does not sustain it. And where do you see that? If you look at the euro-dollar market, which is a clear indicator of where the Fed rates are going to be, if you look at the June 2023 number, i.e. in 12 months' time from now, that rate was predicted to be around 4%, the Fed rate at that time. That repriced by 100 basis points. Of course, Fed yesterday came out and warned about embedded inflation, but that's the job of a central bank. What do you think central bank is going to do? They will talk hawkish because the numbers are at 8% and over, and those will start falling down, and in due course, as it will in over next 1 or 2 months, Fed will talk hawkish, but there is no way they can deliver all the hawkishness that they are talking about, and that should help. That should help keep US dollar from strengthening further, and emerging market economies benefit also from US dollar not strengthening even more than it is at this time.
So then, Manish, how do you see these measures by the government in recent times where they're trying to control their imports, ensure that exports are also controlled in a certain way? How do these measures here stack up as opposed to what you're seeing across other countries, especially emerging markets? Because almost everywhere you look in the world, government policies are turning bearish. The cost of living is going higher and higher. There is the prospect of a global slowdown, including China, which is why we're talking about they bringing in a huge stimulus package. They're mulling a $220 billion stimulus. How is India faring in comparison with other emerging markets? And in terms of what the government is trying to do in tandem with the RBI, what are we doing right? And what exactly do you think are we doing wrong?
So as happens with the case, if you're not energy independent, and India is not, then you become a price taker. So the best thing you can do is you can follow even more market-friendly policies. I mean, you can come up with even more sale of state assets, support the economy even more, be more free market, be more about deregulation, promote private enterprise. I mean, those are things which should be done irrespective of whether the oil prices are, because those are good in the long term. But in the short term, while you are grappling with high energy prices or a potential for high energy prices, because that specter always keeps hanging on your head, that what if the oil goes to a certain level, and how is that going to impact the domestic economy? So that makes things challenging. But the government has to and should focus on things that it has to do on medium to long term. And on that, I don't think there should be any change in trajectory. I think they should continue to be on that path, and also not really feel shy of running higher deficit number in the short term if they have to, and if it is necessary, so long as those deficits are being done for the right reason, to support the economy or to support jobs or to support unemployment, whatever the case may be, or to support industries. I mean, that should be done. And that's where I think India has to continue to do those things.
Indeed, and we'll keep watching these steps that the government takes, what the RBI does with those interest rates going ahead from here. These are difficult times, but there are opportunities within that, and some of them, Manish, you've pointed out too. We'll keep tracking those moves, but thanks very much for joining us with your perspective on what we're seeing currently.
My pleasure.
Thanks. Now, let's